Let's get started. Thank you so much for sticking around. And for the organizers to put us on the program. This is joint work with Ralph and with a PhD student of mine, Neil Shah from Columbia. So this paper is titled The Commercial Real Estate Ecosystem. Hopefully you'll see why. So the context for this is that in the last 25 years, we've seen a great rotation out of public assets into private assets. We see this in the number of listed stocks that goes down, the AUM of private going up. We see this in the allocations of investors like pension funds who rotate out of public equity and fixed income into private and real assets. Now, these assets are special, and so we think this merits attention from the asset pricing community. They get traded infrequently, often in bilateral exchanges. Often we don't observe prices very frequently. They're challenging for risk management. There's scope for volatility laundering. They are lumpy. They have unique features. For example, they could differ by location. And most importantly, maybe they have this diverse ecosystem of all sorts of different types of investors that trade in them. And so we think this is sort of an interesting area for all of us to work on. There was a special issue of the RFS in 2021 that had some interesting papers in this area. I think there's a lot more to do. So what we do in this paper is we develop a valuation and a trading model for these private and real assets that we're going to microfound with a portfolio choice model that features lumpy real assets, so hopefully fit for purpose to Moto's point during the keynote. And in a nutshell, what we're going to find is that there's sort of a couple of empirical results on the valuation side. The first one is that starting from a standard hedonic model, which is sort of a standard way of valuing private assets, we're going to find that this linear hedonic model gets blown out of the water by taking into account nonlinearities of the asset features as well as interaction effects of these features. But the most important finding on the empirical side is that who is in the market at a given point in time matters for the valuation of these private assets. So you could think of it as the prices on the hedonics depend on the characteristics of the investors. We're also going to uncover the structure of trade. Who is trading with who in these private markets? And that's going to matter when we want to do, for example, out of sample predictability. It's also going to matter when we want to do counterfactual. So we want to be able to ask questions like, what would have happened to Manhattan office prices if the foreigners had not bought as many offices in 2013 as they did? Who did they displace? What other assets did these investors buy instead? So those are the sort of things we want to be able to answer with this framework. We're going to apply this to commercial real estate, but we think this applies more broadly to any private or real assets. Could be art, could be maybe municipal bonds, it could be private firms. So let me tell you a little bit about the model. So we're going to have rich heterogeneity here, both on the asset side and on the investor side. So I'm going to call X and T, the features of the assets, and ZIT, the features of the investors. Let me first begin with the valuation model. So sort of in the spirit of these hedonic models, we're going to say that the log value of the asset, the private value, is a function H of both the asset features, that's the standard hedonic model, as well as the investor features, the ZITs. That's sort of the new part here, as well as some residual demand, very familiar from Moto's lecture earlier today. We're going to allow for a flexible functional form for this function H. And one special case is, for example, sort of, again, in the spirit of this hedonic model, a model where the valuations depend on the asset features, but the prices of these features, the beta XIs, depend on the features of the investor. So you get interaction effects of investor features and asset features. So that's specific. And then finally, the price, because these are bilateral markets, the price gets established through bargaining. Let's say the bargaining weights are 50-50 as half the value of the buyer plus half the value of the seller. Now, that interaction specification pops out from a micro foundation where an investor has mean variance preferences and considers adding one lumpy asset to their portfolio. So consider the lumpy asset having risky cash flows next period that are random, N1I. You could think of maybe this as a private equity fund that can actually change the cash flows of this asset, and already has an existing portfolio with stochastic payoffs D1I. And now this investor has to be indifferent between adding this one lumpy asset to their existing portfolio or not. That indifference condition leads to a private valuation of that investor that depends on the expected payoff of that asset, the first term, the risk of that asset, the second term, as well as covariances of the payoff of that asset with all the other assets in that investor's portfolio. So if we put some structure on this problem and make each of these three terms a function of the characteristics of the asset and let these coefficients, beta 0, beta 1, and beta 2 be functions of the investor characteristics, then we get that interaction specification that I showed you on the previous graph. So the point here is that things like heterogeneity in beliefs, heterogeneity in risk aversion, maybe heterogeneity in pre-existing portfolios, as well as potentially heterogeneity in your ability to change the performance of that asset, all lead to heterogeneity in valuations. Okay, so that gives you some idea of what's behind. So the second part of the paper is the transaction model. Okay, and so here we're going to consider an asset that's getting listed for sale with some probability. So you could think this is some building that the seller decides to put up for sale with some probability pi L. Then conditional on a listing, a buyer is going to meet that asset. That's the meeting probability. This is in the spirit of directed search and matching models. And then conditional on a meeting, there's going to be a transaction probability in red. So let me tell you a little bit about the meeting model. So the meeting model we're going to write down sort of in this well-known logistic form, and we're going to basically say that the probability that a particular buyer B meets that asset is increasing in the size of that buyer, because we know that in the data, larger investors like Blackstone are meeting a lot more assets and trading a lot more assets. If that buyer owns more than 2 assets, this is to deal with the fact that there's a bunch of sellers or buyers that are just having very few assets. We're also going to say that if the buyer and the seller are similar sized, they're more likely to meet each other. And then finally, we're going to have this notion of a buyer's consideration set. So if this asset is a Manhattan office asset, we're going to say that the buyer is much more likely to meet this asset if it's an office, if it's in Manhattan, if it's of the same quality, if it's of the same size. So we're going to be estimating the coefficients lambda on this matching model. Okay, and then the last part of this is conditional on having a meeting. What's the probability that this asset will actually exchange hands? Well, that will depend on the valuation of the buyer relative to that of the seller. We're going to say the asset trades if the buyer has a higher value than the seller. And that's where the valuation model and the transaction model interact with each other. Okay, and given our functional form assumptions, that's just a function of the normal CDF. Okay, and then finally, the listing decision itself, we're going to model very simply in order to match in the model the expected frequency of transactions with the actual number of transactions that we see in the data in each year sector. So let me tell you a little bit about how we estimate this model. So the first part, the valuation model, we're going to model this in a very flexible way using a light gradient boosted machine. This is a tree-based model. It's easy to train. It can handle large data sets, categorical variables very beautifully. There's just one little wrinkle here, which is that the valuation of the buyer and the seller cannot be independently estimated. They are connected through the price equation. So we do a recursive, sort of iterative approach to respect the adding up constraint that the price is half the value of the buyer and the seller. Okay. The second part is how do we estimate this matching model? And this was a problem we were stuck on for a very long time. Because in these type of models, you need to essentially maximize the likelihood of the transactions, as well as you need to explain why most buildings are not trading in a given period of time. And so, thinking about why does an asset trade, in fact, requires you to compute the valuation of that asset for every potential buyer, and you need to do this for every asset in every period. And so this is computationally a very difficult thing to compute, okay? Because your denominator is so large, it's a very big sum. And so that's sort of not a feasible problem. And so we had this idea that this is exactly the way LLMs predict the next word in a sentence, okay? In theory, they need to consider the word that it is and every other word in the English dictionary that it's not. And again, every other word in the English dictionary is a very big sum. So that's a very large sum to compute. That's not what LLMs do. What do they do instead? Well, there's this result that says they can just look at a small negative set, a small set of words that it is not. That's called the negative set. The cardinality of the negative set can be small. Okay, you can just randomly draw 1,000 words out of the English language, and that's good enough to estimate this likelihood function. We're going to use that same insight, which is you do not need to consider every potential building for every potential buyer for every potential building. It's enough to consider 1,000 randomly drawn investors, okay? And then what that basically does is it replaces your maximum likelihood estimation with essentially a classification problem. And there's this ranking estimator that the computational science literature, a paper by Ma and Collins, has proven to be a consistent estimator, asymptotically normal, and that this estimator converges to the maximum likelihood estimator as the cardinality of your negative set goes to the full universe. So why real estate? Real estate is a great asset class to do demand-based asset pricing because, first of all, there's a lot of heterogeneity in the assets that you observe, and second, because there's a lot of information about the investors. Why is that? Because every real estate transaction has to be recorded. Now, it's one thing to go from, it's recorded to actually getting the data. So we have these data from Real Capital Analytics. They spent 20 years cleaning this data, and most importantly, scrubbing and figuring out who's behind the LLCs that are buying each of these individual buildings. So we have beautiful data on exactly who buys each building, every office, industrial property, retail property, and apartment property over $2.5 million in the last 2.5 years in all of the United States. So we see a bunch of asset characteristics. We define 60 geographies, think of them as the large cities in the US, and then we see a bunch of portfolio characteristics, including the type of investor, but that we're going to figure out that's actually not all that informative because there's a lot of heterogeneity even within investor types. Okay, so there's a rich ecosystem. Let me show you a little bit about these data. Before I do that, we then supplement this with macro data. By macro here, I mean at the market level, these 60 regions. We have things like market size, purchasing power, occupancy rate in, say, the Manhattan office market, NOI growth rate, net operating income growth rate in the Manhattan office market, and so forth. And then we have very narrow measures of quality at the block level. Okay, so we think of that as our measure of quality of the asset. So all in all, we have about 500,000 transactions, $10 trillion in trading volume, 300,000 investors. Okay, so you can see this is sort of an indication of the data. We have about $500–600 billion in annual transaction volume with this boom and bust. And in terms of the type of managers, we have foreign investors. These could be sovereign wealth funds. These could be Canadian pension funds. We have private equity investors. These could be the Blackstones of this world. We have REITs like Vornado. We have institutional investors. This is your university's endowment, pension funds, and so forth. Then we have two large categories of owner-operator developers. These are the local guys that just are real estate investors. They're the value investors in this market. The locals are just active in one market. The national ones are active in more than one market. We have some individuals, high net worth, and then we have some users. This is Amazon owning its own warehouse, or IBM owning its own office. So we can document some patterns of who owns what. So for example, if we sort the assets by size in 6 equal buckets, we see that these local owner-operator developers, they're sort of specializing in these small assets, whereas the REITs and the foreign investors are specializing in these larger assets. We see positive assortative matching between the size of the asset and the size of the investor, as measured by their total dollar portfolio. We see also geographic diversification that differs dramatically across space. So these local owner-operator developers, by definition, are just active in one market. These foreign, these REITs and these institutional investors are active in more than 20 markets. So some investors are geographically diversified, others are not. And again, that's highly correlated with the size of the investors. So let me show you some evaluations, some main results now. So the first main result is on the valuation model. So the benchmark here is the linear hedonic model, the log linear hedonic model, augmented with a lot of characteristics that the literature in commercial real estate hadn't really considered before, in addition to regional fixed effects and time fixed effects. So we are really giving this regional, this hedonic model, this linear hedonic model, the best shot by including all these fixed effects. That model explains about 60% of the variation in observed transaction prices. Okay, so then the first point we make is that graduating from a linear model to a nonlinear model, but still only considering investment asset characteristics, increases the R-squared by about 15 to 20 percentage points. Okay, so that's the second row. And then the third row is sort of the main point of our exercise on the valuation side, which is that considering investor characteristics adds another 10 to 20 percentage points to that R-squared. And the model ultimately explains 90% of the cross-sectional variation in these transaction prices. And relative to the model without investor characteristics, adding investor characteristics reduces the unexplained variation by about 50%. Okay, so investor characteristics really matter. Which ones matter? The investor portfolio characteristics are more important than the building characteristics, which are more important than the macro characteristics, and so forth. So in the paper, we have a detailed discussion. This is SHAP analysis. We do a lot of things along this way. There's strong nonlinearities. For example, the asset prices are higher if the size of the buyer and the seller is very similar, or much lower if there's asymmetry. As you can see, there's a lot of nonlinearity here. Here's another one. This is a key interaction effect. Remember, in our valuation model, it's all about these interaction effects between the asset characteristics and the investor characteristics. The key one is between the asset size and investor size. So large investors trading large assets have higher values for these assets than large investors trading small assets, or vice versa. Okay, so that's what this chart shows. So the matching model then. So remember, we had written down this functional form for what makes a buyer more likely to meet with an asset that's for sale. All of these coefficients are large and statistically significant, in particular these consideration set variables in the middle, these lambda 3 variables. So for example, if I have a lot of large assets in my portfolio, that makes me much more likely to meet a large asset. Okay, and so like if I have 1% larger assets in my portfolio, it makes me 8% or almost 10% more likely to meet that asset. So you see strong consideration set variables sort of indicating a lot of segmentation between these different market segments. The model works well. It sort of gets the right buyer out of these 1,000 randomly drawn buyers 25% of the time. Random matching would be 0.1% of the time. So the model is 200 times better at identifying the actual buyer from this negative set of 1,000 buyers that it was not. The model also generates these listing probabilities that are very intuitive. They're sort of higher during the boom and lower during the bust. So now let me turn to the applications. How much time do I have? Perfect. So there are sort of 3 applications in the paper. I'm going to talk about 2 of them. So the first one is, it's a very simple exercise. Can we predict the price of properties that transact out of sample? Can we do better than a standard model, a standard linear hedonic model, right? So the exercise is, let's estimate the model up until 2016, and let's try to predict the transaction prices in 2017. And let's do that with the linear hedonic model, and let's do that with our model. And sort of there's 2 targets here. One target is, are we closer to the truth than the linear hedonic model? And as you can see, our model is closer about 80 to 90% of the time. So, vastly outperforms the linear hedonic model. Another way to look at it is the pricing error of our model larger or smaller? You can see our model has about a 50 or 70 to 30% smaller median absolute error, pricing error relative to the linear hedonic model. So what are these different bars here? Well, even though we only train the model up until time t, if we want to predict what the price is at time t plus 1, we also need to know what the characteristics of the asset are at time t plus 1 and what the investors are at time t plus 1. Now, of course, we don't know who's going to buy this asset at time t plus 1, but we can use our transaction model to predict that. And that's basically this right side of bars is where we predict both the characteristics of the asset in X period as well as the investors that are the most likely buyers. And we develop a tool called the potential price distribution to do this. The idea is very simple. We're going to draw a replacement from all the potential buyers. And, if the buyer that you draw has a higher valuation for the asset than the seller, then we're going to say that the asset transacts. So this is going to lead to an entire distribution of prices. And we're going to take the median of that distribution. Okay? That's what this right set of bars here. And as you can see, again, the bottom line is the model does quite well predicting out of sample. The second set of counterfactuals are a bit more sort of structural in nature, where we're going to be thinking about the impact of certain types of investors and what happens when we remove these from the market. So an interesting one is these foreign buyers. As you can see, foreign buyers came in massively in the property markets in the US, sort of starting in 2014, 2015. For example, Middle Eastern sovereign wealth funds, Canadian pension plans, and so forth. And so we want to ask what happened when these foreigners came in, and in particular, who did they crowd out of these assets that they bought? We're going to focus on Manhattan office. We know these foreigners bought a lot of trophy Manhattan office buildings. What happened to what did these alternative buyers buy instead? Okay, and so what we're going to find is that these alternative buyers are 60% of the time, they're still going to buy an office. When they get crowded out of these Manhattan offices, there's a bit of substitution across other sectors. They're going to trade down in size, so they're going to go to slightly smaller size groups. Most of them, again, are going to stay in Manhattan. There's a little bit of geographic spillover, and these foreigners are mostly displacing the office experts that are overweight Manhattan office. So you can do very granular sort of experiments where you look at a very particular type of asset. Finally, the question is, what was the price impact of these, right? So we're going to again use our potential price distribution tool to ask, what if we remove these foreigners from the set of potential buyers? We randomly draw from all the other buyers, excluding the foreigners. They have different willingness to pay for these assets. What would be the price, the median price in that case? And we show that basically would have been 7.5% lower. In other words, the foreigners increased the prices by 7.5%. Over this last decade. In the paper, we do another counterfactual where we look at REIT sales to private equity funds just before the financial crisis. It so happens that these PE funds raised a ton of money just before the GFC, and REITs sold all these assets to them. And you can sort of ask, well, you know, what would have happened with the crisis have looked different if that hadn't occurred. So in conclusion, we develop a new asset pricing framework here for private and real assets where investor characteristics are important. They're an important new hedonic. It recognizes the bilateral nature of trade, the uniqueness of each asset, and the bottom line is that the composition of the investor base matters, both for the expected price as well as for the price risk for the distribution of prices. Thank you.